Welcome to this lecture on intrinsic valuation, where we will continue with discount rates, or the third lecture in the series. Now here in this lecture we will look at relative risk measures, or which you can read more about in chapter 8 in the book. Now we have two main ways of estimating beta. First is the historical or the regression beta. Now this involves regressing the company's past stock returns against a market index, which gives us a specific number, but it's noisy and sensitive to the index that is chosen, and assumes that the firm's past risk is then matching the future predicted risk. And the second is the bottom-up beta. Here we are looking at peer groups of comparable companies in the same business. We take then the beta and unlever them to remove the effective capital structure, and then we average them, and then relever them to reflect the firm's debt-to-equity ratio. So the and the bottom-up approach is usually generally considered superior, as there we have a lower standard error, which can reflect then changes in the capital structure and allows us to adapt to shifts in the company's business mix. Now, beta tells us how sensitive a stock is to movement in the overall market. If beta is 1, then the stock moves roughly in line with the market. That is, it has average risk. If beta has 2, then the stock is twice as volatile. Now, if the market goes up by 1%, we would then expect that the stock would go up by 2%. The reverse is also true if the market then fails. Now, if beta is 0.5, then the stock is much more stable, moving only half as much as the market. So the beta provides a simple measure of relative systematic risk. So how exposed the stock is to broad market movements compared to the average company. The classic way to estimate beta is through regression. So we regress the company's stock returns against the market returns. And the regression equation then gives us then two coefficients. That is the intercept and the slope. Now the slope of this line is the beta and tells us how sensitive the company's stock is to the movement in the overall market. When we report a historical beta, we are reporting essentially the company's levered beta, which then reflects both its business risk and the current financial leverage. While this method is quite straightforward, it is also quite backward-looking and noisy, so which is why we often prefer the bottom-up betas in valuation in practice. Now, historical betas, they suffer from several problems that limit their usefulness in valuation. First, they have a higher standard error. The regression-based estimate is noisy, so we can't rely on it for precision. Second, they reflect the business mix of the firm over the sample period. If the company has changed its business line, the historical beta is no longer representative. So the third, they capture the average financial leverage during a regression, the period we are looking into. So if the firm has changed the debt-to-equity ratio, the historical beta won't reflect the current risk. Now, finally, in small or illiquid markets, trading in a single stock can actually move the market index, biasing the regression results. For for all of these reasons, we often prefer the bottom-up betas, which allows us to build more stable and forward-looking measure of risk. Now here we see an example of why the regression-based beta can be unreliable. Here we see quite low R squared, or very low R squared. This tells us that the overall market explains only a small fraction of the variation in this stock return. In other words, most of the stock movements are company-specific noise rather than market-driven. Now, on top of that, the standard error of the estimated beta is very high. This means that if we report a beta of 1.6, the true beta could be anywhere between, say, 0.5 and 2.5. Now, when regression diagnosis looks like this, we know the historical betas are not a reliable input for valuation, and this is one of the main reasons practitioners often prefer the bottom-up beta. Here is an example with Amazon in its early days. The raw regression beta is 2.23, which just extremely high risk relative to the market. Now Bloomberg automatically adjusts this to 1.82, but notice that the R squared value is only 0.17, which means only 17% of the variation in Amazon returns is explained by movement in the overall market. Now the other 85% is then for specific noise. Now on top of that, the standard error of the beta is 0.5, so the true beta could be anywhere between 1.3 and 2.7. This illustrates the noise problem with regression betas, so they are often statistically weak, unstable, and unreliable for those for use in valuation. But this is why we look for more robust alternatives like the bottom-up beta. Now here is the opposite problem. Sometimes regression betas looks too good to be true. Take Nokia, regressed against the Helsinki Stock Index. The results looks excellent here, with an R square of 0.94 and a very tight standard error on beta. But in reality, this is quite meaningless, as Nokia is such a large part of the Helsinki Index that its own stock movement were driving the index essentially. So if we are regressing Nokia against the index, is essentially regressing Nokia against itself. So the key takeaway here is when beta looks too precise, always check whether the company dominates the index we are using. If it does, the regression beta has no real informational value to us. Now this example with Valiant Pharmaceuticals illustrates the danger of relying on historical betas during turbulent times. Now, during this period we are looking into here, the company was under siege. There was no CEO. The company was under legal pressure. The financial statements were missing, and not surprisingly, the stock returns moved quite largely independent from the overall market. So the regression spit out a beta of 0.36, which by traditional interpretation would mean the stock is very low risk. But clearly this was not the case. So where Valiant was one of the riskiest stock we could own at the time, and shows us as a reminder that regression beta can severely underestimate the risk when firm-specific crises dominate the stock price movements. Now, in those cases, we need to look beyond the regression and use judgment, or better yet, the bottom-up betas. Now here we have two Bloomberg regressions, both for Bombardier. On the left, we see a regression on Bombardier against the S&P 500. The raw beta shows 1.7, and on the right, we regress Bombardier against Canadian TSX index, which suddenly the beta is down 1.2. So here, what happened? Nothing about Bombardier changed. What changed is really the index that we are using. So by switching the benchmarks, the beta we report can jump or fall dramatically. So, and this is not, this isn't limited to the index choice. We could also play with the time horizon or the frequency of returns, weekly, monthly, daily. Each choice gives us a different number. So if we are biased going in and we do want to show the company whether it's riskier or safer, we could tweak the setting until we get the result we want. This is another reason why regression betas can be dangerous. It can give us an illusion of precision, but in reality they are extremely sensitive to our choices. Now let's break down the determinants of beta. At its core, the unlevered or asset beta reflects the business risk of the firm. So first, by nature of the product, discretionary products, cyclical goods, luxury items, and growth firms, they all carry higher betas than staple goods or basic services. Now second, operating leverage. If a firm has a high proportion of fixed cost, its earning will swing more with changes in revenue, which increases its beta. So smaller and younger companies, they also tend to have higher betas because they lack flexibility. Now, finally, the financial leverage. Once we add debt into the capital structure, the risk to equity increases. Which is captured in the leveraging formula, where equity beta is scaled up from the asset beta depending on the debt to equity ratio. But if we try to put it simply, so more discretion, more fixed cost, and more debt all mean higher beta. Now here's how the bottom-up beta works. So instead of running a regression for one firm, we look at the whole sample for comparable companies. For each one, we unlever the regression beta by removing the impact of debt. Then the average across a group, and finally re-lever it using our company debt ratio. Now, which one would we prefer? A small group of similar companies, a large group that's a bit more diverse, or one company exactly like we are the one we are valuing? Now the best answer is a large sample. Now, why is that? Because regression betas are noisy, and averaging across more firms diversifies away much of the firm specific noise and leaves us with a more reliable estimate of the underlying business risk. So what's a comparable firm? Students, they often think same industry, same exchange, or the same market cap, but none of these are required. A comparable firm is simply a firm that shares similar business risk exposures. It could be in a different industry, country, or size group, as long as the underlying risk drivers are similar. So that's the only thing that matters for the bottom-up beta. So the right answer here is none of the above. So when we estimate betas from comparable firms, they often get they often have different levels of debt than the company we are valuing. So to make them comparable, we first unlever the betas, stripping out the effect of debt to isolate the business risk only. Then once we have the average unlevered beta, we adjust it back or re-lever using the debt to equity ratio of the company we are valuing. Now this ensures the equity beta we use reflects the company actual financial risk profile, not that of comparables. Now we use the beta, bottom-up beta, because historical beta, they often can be noisy or unreliable. So this is the process. So first we identify the industry in which the company operates and collect the betas for comparable firms. Then we unlever those betas by removing the effect of each firm's debt. Now next, we calculate the average unlevered beta for each industry. Now after that, we weigh these average based on how much the company value or revenues come from each industry. Now finally, re-lever the overall beta using the actual debt to equity ratio of the company we are valuing. Now this gives us the equity beta, which captures both business risk and the firm's financial leverage. Now instead of relying on noisy regression betas for a single firm, we use the bottom-up approach. Here we collect regression for a group of comparable companies and we average them. By doing this, we dramatically reduce the standard error and gives us a more reliable estimate of risk. Now the beauty of this bottom-up beta is that we can adjust them to reflect the firm's business mix and capital structure. Even more importantly, bottom-up betas can be estimated for companies without any historical stock price data, which makes them especially powerful while we are valuing private companies or IPOs. Here we have a practical example of estimating bottom-up beta for a diversified company. Now each business unit has a different risk profile reflecting in its unlevered beta. For example, fertilizers have a higher beta at 0.99, while logistics is lower at 0.5. Now we can compute the a company-wide beta in two ways. That is revenue weights or value weights based on EV to sales multiples. Now both methods, they gives us almost identical results, or around 0.84. Now this shows that the company diversified risk is fairly stable regardless of which weighing approach we use. This illustrates how bottom-up betas allow us to reflect the actual business mix of a company rather than relying on one noisy regression beta. Now let's put it all together and recap the cost of equity. So the cost of equity is simply the risk-free rate plus beta multiplied with the risk premium. Now there are few important details we must get right. First, there is the risk-free rate. It has to be in the same currency as your cash flow and in the same terms, real or nominal, as the valuation. Now if the cash flows are in nominal US dollars, the risk-free rate has to be in nominal US dollars as well. Now second, the beta, preferably we use a bottom-up beta built from other firms in the same business, and then we adjust for the firm's own financial leverage. That's more reliable than the noisy regression beta. Now finally, the risk premium. There are two ways of estimating this. One is to use the historical premium. For example, the average return of stocks over treasury bonds in the US plus the country risk premium if you are operating in some other riskier market. Now, other way is to use the implied premium, which is based on today's equity market pricing and a simple valuation model. So when you bring all together, the cost of equity reflects then three building blocks. That is the time value of money, measured by the risk-free rate, the firm's relative risk measured by beta, and the overall market risk premium. Now we look at the last puzzle of the cost of capital, or the cost of debt. Now the cost of debt is the rate at which the company can borrow today. It reflects then not only the default risk but also general level of interest rate in the market. Now first, there are two main approaches we use when we estimate the cost of debt. First is the where we look at the yield to maturity on an outstanding straight bond issued by the firm. If the company has bonds that are liquid and widely traded, this gives us a direct market estimate. But the limitation, of course, is that that very few firms have such bonds available. Now, second, we can look up the credit rating and then estimate the cost of debt using a default spread based on that rating. This method is generally more robust because ratings are widely available, but the catch is the same firm can have different bonds with different ratings. So in practice, we need to use the median rating for the firm. Now finally, if you are dealing with a company with no rating at all, it has multiple inconsistent ratings, we can always fall back on the synthetic rating. This is then based on the firm's financial ratio, and from that you infer the cost of debt. Now let's see how we can estimate the synthetic rating for a company when we don't have access to any official credit rating. And the idea is quite simple. We use the financial characteristics to proxy for what the rating agency would assign. The most common starting point is the interest coverage ratio, and the formula is quite straightforward. The interest cover ratio is then equals the EBIT divided by the interest expense. And the EBIT represents the earnings before interest and taxes, and the interest expense are the firm's actual debt servicing cost. Now in this example, let's look at Embraer, where Embraer has EBIT of 790 million and interest expense of 222. So the calculation is 790 divided by 222 equals 3.56, which is then the interest coverage ratio. Now once we have this coverage ratio, we can map it into a typical range of coverage ratios that then correspond to the specific credit rating. For example, a ratio above 8 might map it to AAA rating, a ratio around 3.3 to 4 might map to BBB, and so on. Now, once we have the interest rate coverage, we can map it into a synthetic credit rating using this table. For example, for Embraer, the ICR is about 3.6. And looking at the benchmarks, Embraer's synthetic rating came out as BA1 or B+, if we assume it is a smaller and riskier firm. Now, based on the synthetic rating table, this corresponds to 174% spread. Now, how do we calculate the cost of debt? The formula is then the cost of debt equals the risk-free rate plus the company default spread. Now, if you plug in the numbers, the US dollar is considered risk-free, which we are using here is 4.06%. We then add the default spread of 174, so the cost of debt equals 4.06 plus 174 equals 5.8. This means, given its risk profile, Embraer would face a borrowing cost of about 5.8% in the US dollar if it went to the market today. Now, synthetic ratings, they are useful shortcuts, but they come with some caveats. The tables we use to translate interest coverage ratios into ratings are built using data from US companies. They work fine if we are analyzing large, stable firms in developed markets with interest rates similar to the US, but for smaller firms or those operating in emerging markets where interest rates are much higher, the ratings may not be reliable. In these cases, we need to adjust. Now, one common way is to modify the interest coverage ratio to reflect the higher interest rate environment. For example, if the local interest rates are double those in the US, we halve the coverage ratio before assigning the rating. Now, to estimate the embryo's cost of capital, we need the market values for both equity and debt. The book value of equity is here 3.35 billion, but the market value is much higher, 11.04. On the debt side, the book value is 1.95 billion, but what we need is the market value. We can calculate this by discounting the future cash flow of debt and estimate the cost of debt of 5.8%. This includes the annual interest rate expense of 222 million, treated as a 4-year annuity, plus the repayment of the principal at maturity. This results in a market value of debt about 2.33 billion. Now, these market values of equity and debt, they can then be used to calculate the weights in the WACC formula. We now combine the cost of equity and the after-tax cost of debt by weighing their market values proportions to compute the embryo's weighted average cost of capital. Now, the cost of equity is 9.1%, the cost of debt is 5.8%, and the after-tax it is 3.83%. Now, the weights are 82.6 equity and 17.4 debt. If we multiply through, the WACC comes out as 8.18%. Now, this WACC represents embryo's blended cost of financing, and it's appropriate to use as a discount rate to use then to value the firm free cash flow. Now, when valuing a company, hybrids like convertible bonds should be split into debt and equity. The straight bond part is treated as debt, and the conversion option is equity. For preferred stocks, the cleanest way is to keep it separate and use the preferred dividend yield as its costs. However, if it is a small fraction of the capital structure, say under 5%, you can simply include it with debt, and it won't make a meaningful difference. Now, here we look at how to deal with a convertible bond. A convertible bond is, as you know, has both debt features and equity features. The key here is that we don't want to lump it entirely into debt when we are computing the cost of capital. Instead, we break it down into two pieces, a straight debt component and an equity option component. If we work through this example, the firm has a convertible bond with a face value of $125 million. It pays a coupon of 4%. It matures in 10 years, and the bond is currently trading at a market value of $140 million. Now, if the company were to issue a straight bond today with A rating, the required yield on that straight bond would be 5.3%. So how do we decompose this? The step one is then to figure out the value of the bond if it were straight debt only. We do this by discounting the coupon payment and face value back at 5.3%. Then we run those numbers, we get the value of about $112.92 million. That is the straight debt portion then. Step 2 is the value, the equity option. This is simply the difference between the market value of the convertible bond, $140 million, and the value of the straight debt, $112.92 million, which gives us $27.08 million, which is then the equity portion. Now, step 3 is to feed this back into our cost of capital calculation. Now, the debt portion gets added to the debt, and the equity portion gets added to the equity. That way, we can calculate the weights of debt and equity in the WACC. We are then properly reflecting the hybrid nature of the security. With the bottom line, we don't treat convertible bonds as just debt. We have to break them into straight debt and equity and allocate accordingly when we compute the weighted average cost of capital. Now let's tie everything together with a recap of the cost of capital. Now, the cost of capital is the weighted average cost of equity after tax cost of debt. So the formula is cost of capital equals cost of equity times the proportion of equity in the firm, plus cost of borrowing times 1 minus the tax rate times the proportion of debt in the firm. Now on the equity side, the cost of equity is estimated using the bottom-up beta approach, which we discussed earlier, multiplied by the equity risk premium, and it should always be weighted using the market value of equity, not book value. Now on the debt side, the cost of borrowing should be based on either a synthetic rating or an actual bond rating. We then add the appropriate default spread to the risk-free rate. Now again, we always use these market values for the weights, not book values. And don't forget to use or forget the tax adjustment. Debt gets multiplied by 1 minus the marginal tax rate, because interest rate, they are tax deductible. To summarize, now the cost of equity is based on beta and risk premium. Cost of debt is based on risk-free rate plus the default spread, and we weigh both by the market values. Now put them together and you have the weighted average cost of capital, or the WACC. Now let's test our understanding with a quick example. If we are trying to estimate the pre-tax cost of debt for this firm, notice that the firm already has 1 billion in bank loans outstanding with an interest rate of 4%. But those loans were taken out a couple of years ago when the interest rates were much lower. So the key point here, we do not look at the coupon rate on the old debt. Instead, we ask, what would the cost of what would it cost the firm to borrow today? The risk-free rate is 5%, and the default, the company's default spread, if we were to go out and borrow long term, is 2%. So the pre-tax cost of debt is simply risk-free rate plus the default spread. That's 5 plus 2% or 7%. So the correct answer here is option 3, or 7%. The big lesson here is the cost of debt is the current market number, not a historical number. Now let's work through this debt ratio problem. Now if the firm has a market value equal or market value of equity equal to 1 billion, which is our E in the formula, the debt to capital ratio is defined by D divided by D plus E. Now notice that the question doesn't give us explicit dollar value of debt, but we know from the context of the previous example that the firm also has 1 billion of debt outstanding. So if the debt equals 1 billion and equity equals 1 billion, then debt to capital ratio is 1,000 divided by 1,000 plus 1,000. So it's 1,000 divided by 2,000 equals 50%. So the correct answer here is option 1, or 50%. So the lesson here is whenever you see the capital ratio, you must use the market values, not the book values. That ensures your cost of capital is then reflecting what investors actually demand today. That will be all for this lecture. I'll see you in the next lecture. Thank you.